Stop overpaying property taxes. If you own your home and you're over the age of 60, take a moment right now and grab your most recent property tax bill. Keep it close while you watch this because understanding what's on that bill and what options might be available to you can make a meaningful difference in your retirement budget. Many seniors across the country are paying more than they need to simply because they don't know about the relief programs that exist in their state or how to apply for them. Counties rarely reach out automatically when you turn 65, so the responsibility falls on you to learn about these programs and take the steps yourself. In this video, we're going to walk through the main types of senior property tax relief that are available in many parts of the United States. We'll talk about who usually qualifies, what documents you might need, the most common mistakes that cause people to miss out, and a clear step-by-step process you can follow to check your own situation. The goal is to give you practical, usable information so you can decide what makes sense for your household and act on it before important deadlines pass. Let's begin with why this matters so much during retirement. When you retire, your income often becomes more fixed. You may be living on Social Security, a pension, savings, or a combination of these. At the same time, many costs continue year after year. One of the biggest and least discussed pressures is property taxes. Unlike your mortgage, which you can pay off, property taxes don't disappear. They are based on your home's current assessed value according to your local county assessor. That value is usually tied to what similar homes in your neighborhood are selling for today. Over the last 10 to 15 years, home values have increased significantly in many areas across the country. In some neighborhoods, they have risen quite a bit. As a result, assessed values and tax bills have gone up too. For seniors who bought their homes decades ago and planned their retirement carefully, this can create real strain. You might have paid down or paid off your mortgage, kept your lifestyle steady, and still find that the tax bill each year is larger than the one before. This is a common challenge, and it's one that lawmakers in many states have tried to address by creating targeted relief programs for older homeowners. These programs are not automatic. You usually have to apply for them, provide proof of eligibility, and meet deadlines. But when used correctly, they can help reduce the annual burden and make it easier to stay in the home you've lived in for many years. They recognize that many older Americans have built up equity in their homes over decades, but now live on incomes that don't rise as quickly as property values. This situation affects daily decisions about healthcare, groceries, home maintenance, and even whether you can afford to keep living in a familiar neighborhood with longtime friends and memories attached to it. Staying in your own home often supports better physical and emotional health because it keeps you close to doctors you trust, neighbors you know, and routines that bring comfort and stability. It also helps preserve independence and reduces the stress that comes with moving later in life, which can be both expensive and emotionally difficult. Let's look at the four main categories of senior property tax relief that exist in a large number of states. Keep in mind that every state and sometimes every county has its own rules, so the details for your area may differ. The important thing is to check specifically for where you live rather than assuming one size fits all. What works well in one state might be different in another, which is why taking the time to look up your local information is so valuable. The first one is the senior homestead exemption. This is probably the most widely available type of relief. A homestead exemption lowers the taxable value of your primary home before the tax rate is applied. Many states offer a basic version to all homeowners, but they often provide a larger exemption for seniors. The idea is to give extra protection to people on fixed incomes who have lived in their home for a long time and contributed to their communities over many years. The amount of the exemption varies a lot depending on where you live. In some places, it might reduce your assessed value by several $1,000s. In others, it can be higher. For instance, imagine your home is assessed at $300,000 and your local tax rate is around 1.2%. Without any exemption, your annual bill would be roughly $3,600. If you qualify for a $25,000 senior exemption, the taxable value drops, and your bill could decrease by a few $100s each year. In areas with higher tax rates or larger exemptions, the yearly savings can be more noticeable and can really add up when you consider other rising costs like healthcare or home repairs. To qualify, you generally need to own and live in the home as your main residence. Age requirements are often 62 or 65, though a few places start a bit earlier. In most cases, the application is a one-time process. Once approved, the exemption stays in place year after year as long as you continue to meet the basic rules, such as living in the home and keeping ownership in the qualifying person's name. This makes it relatively straightforward for many seniors. It can bring a sense of stability because you know the reduction will continue without having to reapply every single year, giving you one less thing to worry about in retirement and allowing you to focus more on enjoying time with family or pursuing hobbies you love. The second major type is a property tax freeze or assessment limitation. This option is especially helpful in areas where home values keep rising. When you qualify, your home's assessed value is locked in at a certain level, or its annual increases are capped at a low percentage. Even if market prices in your neighborhood go up over the next 10 or 20 years, your property taxes stay based on that earlier frozen number. This protects you from steady year after year increases that can outpace your retirement income and create ongoing financial worry. States like Illinois, New Jersey, Texas, Oklahoma, Tennessee, and South Carolina are among those that offer some version of a freeze or limitation, though the exact rules differ in each place. Most of these programs have income limits. The ceiling might fall somewhere between $30,000 and $65,000 per year, depending on the state and sometimes the county. When calculating income, they usually count Social Security, pensions, and retirement withdrawals, but some states allow you to subtract certain medical costs or disability payments, which can make a difference for those with higher healthcare needs. Age requirements are typically around 62 to 65. The real benefit of a freeze shows up over time. If home values in your area continue to rise at average rates, the difference between what you pay and what your neighbors without the freeze pay can add up to a meaningful amount across a long retirement. It lets you keep more of your savings and income for daily living, healthcare, or other needs, instead of watching it go toward higher taxes on appreciation you haven't cashed out. Think about how this could affect your peace of mind. Instead of wondering every year whether the next tax bill will force you to cut back on essentials or dip deeper into savings, you have a measure of protection built into the system. This kind of long-term stability is valuable for seniors who want to age in place and remain independent in their own homes for as long as possible, surrounded by familiar surroundings and community connections that support a higher quality of life. The third category is the property tax deferral program. This one is designed for seniors who have substantial equity in their home but limited monthly cash flow. After paying for groceries, medicine, insurance, utilities, and other essentials, the property tax bill can feel overwhelming even when the home itself is valuable on paper. A deferral program lets qualifying homeowners postpone paying part or all of the tax bill until the home is sold or transferred to heirs. The deferred amount becomes a lien on the property and usually accrues interest at a low rate set by the state. When the house eventually changes hands, the balance is paid from the sale proceeds. Programs like this exist in states such as Oregon, Washington, Colorado, California, Massachusetts, and others. Because the taxes are not forgiven but only delayed, income limits are often a bit more flexible than in freeze programs. This gives more seniors the chance to stay in their homes longer without needing to sell quickly or take out higher cost options like reverse mortgages. It's worth looking into if cash flow is your main concern rather than permanently lowering the tax amount. Many seniors find this helpful during years when unexpected medical expenses or home repairs come up. It provides breathing room while still preserving the equity you've built over a lifetime, which can be important for leaving something for family or covering future needs. The fourth type is known as a circuit breaker tax credit. The name comes from the idea of protecting against overload. If your property taxes represent too large a percentage of your total household income, you may qualify for a credit that brings the burden back down. Many states set a threshold percentage and offer stronger benefits for seniors because fixed retirement income makes the limit easier to reach. Some programs also extend help to renters. recognizing that higher property taxes can lead to higher rents for those who no longer own their homes. These credits are often claimed when you file your state income taxes rather than through a separate county form. In some cases, you can file amended returns for previous years if you missed claiming them earlier. The amount varies by state and situation. It can range from a few $100s up to more than $1,000 in places with generous programs. This puts money back in your pocket or reduces what you owe. For households living close to the edge each month, even a few $100s returned can help cover important needs or simply reduce stress around bills, giving you a bit more flexibility in your monthly budget. Now that you know the main categories, it's important to understand 3 common mistakes that cause eligible seniors to lose out on these benefits. The first mistake is missing the application or renewal deadline. Every program runs on a schedule, and most deadlines fall between January and April, though some states have later dates. These cutoffs are firm. If you miss one, you usually cannot get the savings for that tax year. The best way to protect yourself is to research the deadlines for your area as soon as possible, write them on a physical calendar, and set phone reminders. Give yourself at least 3 or 4 weeks of buffer time to gather paperwork and complete the forms without rushing. Life in retirement can get busy with doctor visits, family events, and daily routines, so building in extra time helps avoid last-minute problems that could cost you money. The second mistake involves changes in ownership or marital status. Adding a child to the deed for estate planning, the passing of a spouse, or refinancing that changes the title can sometimes cause the exemption to be removed automatically. Counties don't always send a clear warning. If anything about the ownership of your home has changed in the past couple of years, it's a good idea to call your county assessor's office and ask them to confirm that your senior relief is still correctly applied. A short phone call can prevent an unexpected larger bill later. These kinds of life changes are natural, but staying on top of how they affect your tax status keeps everything running smoothly and avoids surprises. The third mistake is overlooking annual income verification forms. Freeze programs, deferral programs, and some exemptions require you to confirm your income each year. These forms often arrive in plain envelopes and can be easy to set aside. Make it a habit to open any mail from your county tax assessor, revenue department, or state taxation office on the same day it arrives. Complete and return verification forms quickly, preferably with tracking so you have proof. This simple habit can save you from losing benefits you've already qualified for and gives you confidence that your paperwork is in order. Here's a practical step-by-step plan you can follow to move forward. Start by researching the specific programs in your state. Go to your state's Department of Revenue or Department of Taxation website. Search for terms like Senior Property Tax Exemption, Senior Homestead Exemption, or Property Tax Relief for Seniors, along with your state name. Most states have dedicated pages that list eligibility rules, income limits, and deadlines. If the website feels confusing, call your local county assessor's office. Tell them your age and ask what senior property tax programs are available in your county. Request that they mail you the application forms if possible. Write down the names of every program they mention. Don't hesitate to ask questions while you're on the phone. Government staff are there to help explain the process in clear terms. Next, gather your documents in one folder so you're ready when you sit down to apply. You will typically need proof of age such as a driver's license, state ID, or birth certificate. You'll need proof that the home is your primary residence, like your current tax bill or a utility bill in your name. Proof of income is important. Recent tax returns, Social Security benefit letters, or pension statements work well. And you'll need proof of ownership, such as a copy of your deed or a mortgage statement. Organizing these ahead of time makes the whole process less stressful and faster to complete, especially if you prefer doing things at your own pace. Then submit the application. You can usually mail it, drop it off in person at the county office, or use an online portal if one is available. Whatever method you choose, keep clear records. If mailing, use certified mail with return receipt. If applying online, save screenshots and confirmation numbers. If you get a denial and believe it's incorrect, you have the right to appeal. Good documentation makes appeals much stronger. Take notes during every step so you can refer back if needed at a later date. If you feel unsure about any part of the process, consider asking a trusted family member or a local senior center for help. Finally, set yourself up for long-term success. Put a recurring reminder in your calendar for about 45 days before the main deadline each year. Label it clearly so you remember to check for any verification forms and handle renewals. This small habit can protect the benefits you've earned from slipping away due to overlooked mail or forgotten dates. You might also consider sharing the responsibility with a trusted family member so there's backup support if health or memory becomes an issue later on. Planning ahead like this is part of taking good care of your future self. Property taxes are one of the few major expenses in retirement that can keep increasing even when your income stays the same. You can pay off your mortgage, reduce other spending, and manage your budget carefully, but the tax bill can still grow if home values rise. The relief programs offered by many states exist because lawmakers understand this challenge for people living on fixed incomes. These programs won't solve every financial issue, but they can provide meaningful help when you qualify and stay on top of the requirements. Combining these relief options with other smart retirement habits, such as reviewing your overall budget regularly and staying informed about changes in local rules, can create a stronger financial foundation. Taking action starts with checking your own eligibility rather than waiting for someone to contact you. Every county and state is different, so the exact numbers and rules for your area will depend on where you live. The time you spend researching and applying can pay off in lower bills and greater peace of mind for years to come. Beyond the direct savings, there's the comfort of knowing you're being proactive about your finances. Many seniors report feeling more in control after they successfully claim these benefits and are able to redirect that money toward things that truly matter to them, whether it's travel, grandkids, or simply covering everyday expenses without worry. If you have older friends, neighbors, or family members who own their homes, consider sharing what you learn. Many seniors are quietly worried about rising costs but don't know where to begin. A simple conversation can point them in the right direction and might even spark a helpful discussion about their own situation. Retirement is a time when community and mutual support become especially valuable. Whether it's sharing information like this or simply checking in with each other, take your time with this. Start with your state website or a call to the assessor's office. Gather your papers, note the deadlines, and take the first step that fits your situation. Looking after your finances in retirement often comes down to these kinds of practical actions. The more you understand the system, the better position you'll be in to make the best choices for your home and your future. Small, consistent steps like this add up over time and contribute to a more secure and comfortable retirement. Thanks for watching. I hope this information helps you review your own property tax situation with more confidence. Take care of yourself and best of luck as you explore the options available in your area. Remember, being informed is one of the best tools you have for protecting your hard-earned savings and enjoying the years ahead in the home you love. Small actions today can lead to greater security and less financial pressure tomorrow.